So, without any further delay, I want to start this one of the 2026 first webinar that I personally spend the most time. Naturally, throughout the year, I get a little bit lazy when it comes to our webinar content creation. But this one is something that I pay a lot of attention because that defines our business and our business. All right, yeah. So it's more Houston, more Dallas people. I hope you guys are all warm. I know this week has been crazy, and hopefully everybody's okay. So without further ado, I think we have about close to about quite a few participation here. So glad that you guys able to make it. My goal is to keep it super simple for you guys. If you are financial savvy or in terms of understand finance, economics, and the economy of United States and economy in general. My goal is to give you the information that I was able to collect that is valuable for people who are just starting up or people who are extremely or from a finance industry, right? People who are even for economists. So without so today's topic is our investor risk and how we see 2026 as a prediction for multifamily and overall for the economy. With full disclosure, I am not an economist, but if you want to go look at my slides again and criticize me later on, definitely do that. The number is 281-559-7061. This text goes to me, to Camilla, and to Farah. I don't see it quite often, but Camilla and Farah, they can send you the slide, right? And this will be recorded, so it will be on our YouTube channel as well. Now, again, this is just we do this legacy webinar once a month. And the goal is to educate ourselves, educate our investors, educate our partners, and even our competition, and try to get better 1% every day, every month. So again, this is not a legal advice, not a financial advice. This is not we're not attorneys, we're not CPAs, we're not financial advisors. So if you ought to make any decision, please consult your brokers or your professionals. Now, who is this for? We have been focusing very specifically for people who wanting to get into a second stream of income. Meaning, if you are a professional physician or an engineer or any kind of W2 professional, this monthly webinar series that we call it Legacy Webinar, and today's one is the first webinar for 2026. That series is for you, right? We do it once a month. Personally, me and my team, we spend a bunch of hours to prepare that webinar for one goal and one goal only. We try to keep it a non-salesy webinar. This webinar is not to sell you anything. It's purely to first, show what we know, what we can do, and also share market knowledge with you. So if you're a business owner or if you're a practice owner, right? If you're an attorney or a physician, or if you're just somebody who invests and make a living like that, right? You're a stock investor, you're a real estate investor, or a crypto or any other kind of investor. And if you're new to your job or you're just starting up in school, if you know anything about IRS, this is the webinar that you want to be. I start my webinars with some unknown facts or known or facts less known, and I keep it in a way that give you a little food of thought. So the first fact less known is that do you know that an average top middle class American family can only survive their lifestyle up to 4 months without income? Meaning, a family like mine or a family like yours or most of us in this webinar, if you lose your job today, the current lifestyle that you can sustain is only 4 months, and that's an average study that been published and been very, very well known, published by IRS and other US departments. I call this a fact less known, and it truly is. I mean, I talk to my friends and family, and when I ask them, and hardly they have any idea, and they can't even fathom the concept of or understand the concept of losing a job and be able to even go for a month without it, right? Fact less known or less understood is you can simply increase your. Let me say it this way: it doesn't matter what you make, right? What matters is what you keep, right? So if you are making $100 a year or $100,000 a year as an income, you really have to have two ways to increase that income. One, that you work hard, work more, find a new job to get a last side hustle or a second source of income, and try to increase your take home or your savings or your income. The other way is to keep making what you're making, but save more, right? So increase. So my my experience tells me that you can increase your income by 30% without putting more hours or even cut hours, and make more by just in some cases you can even make more than 30%. And how do you do that? You just do the investment smartly that actually brings you some tax benefits. This webinar is not for this topic today, but I wanted to bring this fact less known or fact less understood and share with you guys. This is my team. If you don't know me, my name is Sis Shamim. I'm a founder and CEO for Headway Investment. In this slide, you'll see my wife, Anna Mumar, Brian Farrow, our Investor Relations Director. He's not with us anymore. Well, he'll join us later in a few months because he's on sabbatical. And then Umar Naqvi is our financial advisor, CFO. With that, I've got Camilla. She's an investor relation team member, and Farah. She's also our lead investor relation. So if you guys, if you have a problem, these are the one who are gonna solve it. Right. Today we own about 3,300 apartment complex, and we have about 430 active um, passive investors. Our target has always been to get to 25 to 30% average annual return. We are somewhere around 550 millions of assets under management. How do we get there? About 15 years ago, when I started the journey, I honestly didn't know what I was doing. It took me 5 years to understand the four key principles that I want to apply to be able to produce results for myself and for investors. Not every year is same. And the last few years have been extremely hard. But what really saved us, right? We did not file any foreclosure. We did not lose any of the investor capital, and that's been happening uh, quite commonly with our competition. I've seen people losing their assets to lenders, and and uh, and it's happening pretty aggressively. We stay focused by keeping our discipline, and it's staying consistent. But more importantly, we stay purposeful. Right? Our goal is to um, our goal is to make make our efforts counted. Meaning, we work for apartment complexes, and we believe that in the United States there is a housing crisis. I can tell you almost all day long there are some of our own employees who work for us in our apartment complexes. Even they cannot afford the apartment complex that they work in. Right. So we definitely have a true housing crisis, and we think our purpose is to help our nation and fellow Americans to fight that. I personally also believe in living fully and giving more. I always say with my core teams, like if you make a dollar, you better be ready to give away that dollar if you have everything, right? Meaning, when you're making more, you have more responsibility to pay it back. Today, the agenda is to just get 1% smarter. We're going to look at the U.S. economy in general, and we're going to talk about multifamily nationwide, and we're going to talk about multifamily in Houston. I'm going to touch a little bit on Dallas and other markets. But I can tell you right now that Houston is really a leading market in Texas. We own properties in Houston, Dallas, and Phoenix. I picked one city that within Texas is leading right now in terms of growth or positive trend. And then last, I'm gonna try to conclude with some kind of advice what I'm applying for myself to our investors. Right, what kind of risk I'm taking this year, what kind of um, investment I'm going to make this year, and how I'm going to navigate 2026. Some of you would ask me this question, so I want to put it up front. There are several resources and references that I have used. So what I've tried to do is I've tried to go on, and this is what I do every year, starting in December, and I took 3 to 4 weeks in December, and then about 2 to 3 weeks again in January, just to refresh what I've learned over the last year and this year, and I go to some of the big powerhouses in commercial real estate, like Walker Dunlop or CBRE, and then I go to Bureau of Economics, federal government data, and I try to pull data from Bureau of Labor Statistics. I try to go to see what data is there that's relevant to us for Bloomberg. I also follow Dr. Mark. He is an economist out of Texas A&M, and he's the guy who always stays really conservative with his estimates. I also try to go and look for some of the aggressive narratives. Right. What I try to do in this presentation is that I try to ignore all the aggressive narratives. Meaning, if there's a powerhouse, or if there's a group or a company out there who's trying to predict that 2026 will be a year of prosperity and you know 10% GDP growth, I'm not looking at these guys. I'm also not looking at people who are a little bit less aggressive, but to me, they're still aggressive. For example, there are groups out there who are predicting, who's presenting data that the U.S. economy is on the surge and the growth is extremely viable. Even though I agree with it, but I don't really put all of my investment decision based on that one particular narrative. So throughout this presentation, what you will see really two areas: how a U.S. economy going to behave from our view, and again, I'm keeping a conservative narrative, and then how apartment complex, multifamily, or retail, or offices, medical building, medical real estate, going to behave overall, as well as in Houston particularly. So CBRE is one of the top multifamily economists in real estate company out there. They predict that the GDP growth will slow down from 2.3 last year to 2%. It's a small change, but that it is important to note that overall the GDP will be slowing down. And then there's the commercial, they also are predicting that the multifamily sector will be net positive because of several factors, and we're going to dive into it in a little bit. The healthcare sector is going to be dropped drastically in 2026 because the new supply is coming in and the leasers or people who are occupying those medical buildings, they have to be super smart and have to save cost, because that is the only way to get through 2026. Retail sector, strip malls and things of nature, even though we don't invest on this, but the a lot of reports that I've seen, this is going to survive and do good in 2026 as well. Let's see how this all plays out. So the narrative of CBRE that I was able to pull, they're seeing GDP growth to be lower since from 2025 by 0.3%. Inflation is going to drop, which is a good news. Job growth will be down by 2.3%, by 2.3%. Unemployment rate will go up. It will go down. That's actually a good news, because your interest rates and any borrowing power to the consumer will increase. And the federal cuts, right? Last year, the federal rate or federal government dropped their interest rate by, I think, 4 times. So this year they're predicting they're gonna only do 2 cuts. It's still a good news. Is it awesome? Absolutely. I don't think so, because 2025 was still a aggressive year to drop the rates. Similarly, they're also expecting, starting right as of last quarter 4 of 2025, our Treasury 10-year bill was hovering around 4%, between 3.9 and 4%. CBRE and the Bloomberg research says that up until the next 3 years is going to be like that. It's not going to go down too aggressively, but you can see the range. Like, for example, 2026, the green section shows you the range, right? So that chart tells you in 2026, there's a high possibility that your 10-year treasury might drop to all the way to like close to 3.5 and may go up all the way to 4.5. But generally speaking, they're expecting the treasury to stay the same, which in my opinion is a good news, because that's the only way consumers and borrowers and sellers and buyers can predict what to underwrite their models with. One other news I want to share with you, I took it from Dr. Mark. Their their CEOs got paid $95 million. It's a massive, most amount a CEO got paid. While on the same side, Accenture fires 11,000 people who fail the AI reskill test. So, for example, if you're in AI, or if you're in IT or any kind of job, a desk computer facing office job, what Accenture did, they give everybody a few months to get trained on AI. They did a retest and they terminated 11,000 people because they were not able to catch up with the AI skill test. Elon Musk wins 1 trillion paycheck, and that's the biggest disparity between your middle class and your rich. Amazon is, there was a news, I'm sure most of you have seen it. There was a leaked document that got to New York Times that Amazon is planning on dropping and laying off 500,000 jobs because of the AI. And that will impact the delivery costs to your house and my house for my cat food by 30 cents. So that's all happening right now. And that is one of the reasons why, even though you see your stocks, your market is all time high, you see all the positive news around it, but the job, that's one, really the two really big factors. The job growth and the inflation drives the economy, right? So as you can see, this is happening. This is not going away, right? And my job today is to figure out today is to share with you what I think going to happen. You can see the job market. This is a non-farm job data, meaning all the offices jobs, their record stalled, right? They've been hovering between 2 to 3% change up and down, and there's no significant move there. Again, you have a lot of money pumping into the economy, but the AI and other factors are also dropping the jobs drastically. The cost of living is going up. You see the data from 2020 and onwards, it's just upward trajectory, right? Electricity, rent, car prices, food prices, they all have gone up, right? So that just tells us that, this 2026, 2027 uh, will be difficult on several avenues. And what are the avenues that will be resilient or survive smartly from there? Let's look at the house prices. U.S. house appreciation dropped, right, from the times almost 11% so between 2020 and 2023. And if you guys have seen those pricing drop because of the interest rate spike, that's what happened. Median price per foot has been dropped, right? And then this is the price per median listing price per square foot in America is about 225 right now. To be able to afford it, it has to come to 200. And that brings me to my next point is there's just not enough house being built, right? So now you can see how the job cut, the slower GDP growth that's been predicted by several economists and pundits, also translating into less homes being built. And that brings me to another point where in if you compare the data as of today or as of last year, 2025, our population is 342 million compared to 1965, its population 165 million. And you can see the construction. So this blue graph tells you that the construction has consistently going down in the numbers, even though our population has been increasing. And that's one of the reasons why you see a lot more mobile home parks are getting created. A lot of the rents has been increasing, and there's consolidation that's been happening over the years. So what do we see in terms of multifamily? We think this all going to make multifamily more resilient. The competitive market, the price reset, right? So we all know in last few years, the price have been reset for about 20-30%. That created a huge opportunity for buyers and investors like us to get to those assets where those prices will never be the same, right? Even though the uncertainty remains the same, I strongly think that 2026 will still be uncertain in several ways. And we have to watch very closely how this job market and inflation plays out. But as far as multifamily apartment complexes is concerned, at the end of the day, people still have to live somewhere. Meaning, as these cost and inflation going up, your rent will go up, your cost of operating apartment complex will go up. But at the same time, nationally speaking, and especially in Houston area, people who are from Austin and Dallas, you guys know that the construction has gone up or skyrocketed in those cities. Houston was still behind on that. And now in 2022 and onwards, because of all the financing stop, there's not been any more construction came out in the city. So all in all, it's just still, to investors, you want to stay cautious, but you want to also align your investment goal accordingly. All right. I also think the rent growth will be softened because of the job. But again, because there's not enough construction, enough supply in the market, your occupancy will continue to be higher and increasing. Your single family houses, cost of buying a single family house is extremely high. And this later in this slide, I'll show you owning a house for mortgage monthly payment versus a rent is extremely different. We have been seeing this, right? The renewals are happening much stronger in last few months. The effective rent growth is kind of ticking up. It's not aggressively going up, but it is going up. And I personally would stay away from markets like New York or Denver's and Boston and California and Seattle and all of those areas where there's any kind of rent restriction. Right. You want to stay clear from those markets because cost of running an apartment complex is going up. And if the rents are controlled, they're talking about it. It's not been, finally a legislation just yet. But if that happens, and I think some of the cities already have it, you definitely want to stay away from those markets. Overall, see this chart. This chart shows you the rent growth from city for each city. So the highest is on the left is San Francisco. I personally ignore all those markets who San Francisco will always going to have a highest rent growth, but then it's still not profitable. Say for Boston, Chicago, New York, Orange County, you definitely want to look at Minneapolis, San Jose, Los Angeles, Philly, Seattle, all of these markets. I personally do not touch those markets. What I try to see is at the bottom half is where's the Midwest, how the Midwest behaving. So you definitely see Tampa, Atlanta, they're a good market. Portland still um, comes under some kind of rent control. So let's try to stay clear from that. Surprisingly, Dallas and Orlando is still there's a big swing that where the rent can go. I think in Dallas rents will come down. We have some investments in Dallas and we see rent being compressed and the downward pressure is real over there. Same for Houston. For Houston is still we think we are seeing day in day out 2 to 3% increase is pretty possible. Look at you obviously want to stay clear from Austin, Denver, those kind of areas that the rent growth is actually negative. There's one more report that I pulled from Berkadia. That's one of their really big commercial real estate, and they're predicting that in Houston, particularly, the manufacturing investments will manufacturing investments in healthcare will surge the demand, right? So it just tells me that our Houston's fundamentals are still strong. They're predicting about 10%, 10 basis point year-over-year occupancy to go up by Q4, fourth quarter 2026, and the effective rent going up by 0.2%. So remember, whenever you have a case like this where the economy is kind of struggling and you still don't have enough supplies, one of two things will happen. Either the rent will go up or the occupancy will go up. Now, if the occupancy is already high all times, then you're basically looking at rents and occupancy both go up. It's usually not the case, right? Anytime when that kind of thing happens, you always see builders coming in the city and building more, right? Rent share to wallet will decrease. That's also a unique data point from Berkadia. What it means is that people wages will increase so that the rent and the total expenditure of the month is going to go down, meaning you will be able to afford a little bit more. But again, you can collect all of that data in one bucket, but your real bucket is your inflation and your job growth, right? If you can understand those two concepts or can be able to monitor those concepts, all of the micro data meaning North Houston. Like if you look at the slide, and I don't want to read it through, but it talks about what are the areas that is going to perform better. They're talking about North Houston. They're talking about Rosenberg, Richmond area. But overall, Houston particularly is positioned as per the Berkadia is positioned to go up in occupancy and rent increase. Let's look at one other slide here. Berkadia thinks that the rent, the occupancy. So look at the left chart. Your left hand side is your rents, right hand side is your right hand side is your occupancy, and the bottom you see the years. So they're expecting the rents to be somewhat same and the occupancy to cross 95%. Right. Similarly, let's look at the deliveries and absorption. If you guys are not aware of the concept of deliveries and absorption, all it means is that how many units they think it will come in a certain year and how many of them can it be absorbed. So look, what you'll see interestingly in 2020, right? Your supply was much higher than your absorption. And see what happened in 2021. It just flipped, right? Because construction stopped. I'm more interested in what's going to happen in 2026. I think they they're predicting, conservatively speaking, they're predicting that the number of deliveries, meaning new supply or new apartment complex, will be lower, and absorption will meet it. Right? Now, to me, a conservative view, but it's still good for Houston multifamily market. That's why I titled this slide as a bullish narrative. Let's look at the employment. It's an encouraging data in my view. You see a slight uptick in the employment trend for Houston market. This is a micro market we're talking about. Houston, Dallas has a similar data. Austin has a much lower data. Austin is predicted to go down in the employment trend. Estimating by December 30, 2026, about 3.5 million employment going to be produced in Houston. That's a big number, guys. And that's 1.2% year-over-year increase. Employment by December is also so new jobs is 3.5, and you also have a 20 basis point increase in unemployment. Meaning, again, as those AI and new technologies coming in, I don't know if you guys have seen that or not, but Toyota came back with their hydrogen car that is actually in my opinion, going to be a killer for electric cars. So if those kind of things happen, these numbers can go upside down. Median house income will increase by 4.2%, and it's going to touch almost $90,000. That's been the highest. If this is a data new to you, I can tell you that median household income for a very long time has never gone more than $65,000-$70,000 in several years. So what does it mean to our what does all mean to owners, right? People like us, people who are on this webinar who own and operate apartments? Expect occupancy trends seen in 2025 and 2026. So if some of your apartment complexes have been struggling with the occupancy, you got to do something to improve and add value. Some of my investors are also looking at a lot of money being spent on new flooring, new paint, and new renovation, because we believe that if you don't touch the market on its own level, we never be able to actually increase. Forget about increasing rent, actually increase occupancy. Given the weak development pipeline, competition will be over the next few years, right? So even though there's a new recent deliveries coming up overall in Texas, Houston is still not there yet. Six, the two main focus that we have been looking at within Headway is we are focusing extremely hard on our operational efficiency. We have been terminating people, hiring new people as based on the performance. But more importantly, we have been grooming and maturing and training them very, very aggressively. 80% of my time actually been these days is going into employee development. So that one thing will, I believe, will going to stay the same no matter if the market is good or bad. You got to do that. I also think for investors, the Houston market is, to my view, going to grow the rent, but also because of that, just remember, we are not the only one looking at the data, right? Meaning the whole nation is looking at what Houston and some of these markets who have less supply will do to it, right? The only risk that I see in Houston market is the immigration and the challenges that's going on with the deportation and other things. But if those things being controlled, by the way, like any of you or including myself, outside pundits and economists are also using very cautionary words when it comes to predicting what's going to happen in 2026. And that's only one reason, is because the current administration is kind of very unpredictable. Some months are up and some months are down. And so when I'm looking at the data and trying to formulate my business plan, I'm getting mixed reviews from all over, purely because it's very hard to predict what's going to happen in Washington. 26, as far as your investors are concerned, I think the prices will go up. I strongly think that the frozen capital market interest rate will going to settle. The frozen capital market, when I say frozen capital market, meaning institution guys, New York guys, California guys, they're going to start jumping in Texas, especially in Houston market, because that's the only market they can see that still have 24 months or so to um, to perform and then get an exit with their return objectives. I also think that the institution guys will push some of our local investors. Meaning, say if you are investing for a return of 25%, well, that will go away. You'll probably be looking at returns of 20%, maybe less, 15%, maybe even less than that, right? So, and that's always happened. Like Houston always offsets nationwide economy, right? So Houston microeconomy is kind of offsetting the nation's macroeconomy. If nation's macroeconomy is doing awesome, Houston kind of wobble and the other way around. I think we are in the top of the market now for Houston, and I also think outside capital will going to increase prices over here. So I believe 2026, 2027 will going to be a strong year for any owners and operators to sell, if or even to refi. If you guys are looking into those scenarios, I'm particularly looking at very closely, and we'll pull the trigger on selling some of these assets that we want to sell in 2026. So in summary, yeah, if I can summarize in one word, there is an upside, even though there's some uncertainty, right? You got to pick what you're looking for, right? Definitely look for resilient asset-backed investments, and by that I mean your real estate, your land, even your gold. Look for depreciation. That is one way that I feel very strongly about it, because it can increase your income by 20, 30, 40% without doing anything, right? I'm staying very cautious when it comes to stock market. I have liquidated some of my positions for the stock market. I have very limited interest and investments in crypto, so I'm not too worried about that. But if you are a crypto investor, you want to be super careful about it. Um, Definitely rebalance your employer sponsored retirement accounts, right? If you have a 401 or other accounts, if ever, I've told several of my investors to, definitely review your account and see what changes can you do to make it a little bit more conservative this year. With that being said, I want to add one other thing here. I think there's in any economic prediction, you have a 50-50 chance, 50% chance to be right or wrong. And it's kind of crazy and terrible how it is, but that's true. But what I can leave you guys with one food of thought is that the few things that you want to keep watching carefully. Definitely see what happens with the electric vehicles, with these hydrogen cars, and see how this um, number of data centers coming in. And if you have a way to monitor it, and if you're into it, you can look at Bloomberg and other platforms, and they report how many data centers coming up in your city or your nation, and that will impact your electricity costs. I also think that if they go too deep into the AI data center construction and they don't produce results, I think that could also be a black swan event. Overall speaking, that to me that's a very low probability of happening. What I can tell is that the best thing that happens to apartment investors is that at the end of the day, people still have to live somewhere. These people who are working or going through a transition from a manual job to a AI related job or whatnot, there may be a swing, but those this housing crisis is not going away. So I feel very strongly about B and C product, especially in the Houston market because there's no supply. I feel strongly about A product as well. The household income is increasing in the area. To me it doesn't mean anything. But when I look at the approach, I've seen our competition really marketing any of their investments by focusing on one aspect, which is the household income. Well, guess what? The household income has gone up overall throughout the nation, right? What you want to see, the employment diversification and the employment growth in that area. The Other than that, this is really what my perspective going to be on the uh, what other I call it black swan events, right? What can happen that can trigger whatever we are seeing that going to happen in 2026 will be upside down, right? What are the situations that can really impact the job growth, inflation, um, that combined to be a GDP growth, right? With that, those of you who are new, please bear with me if you already know us. We invest heavily in apartment complexes. We do have an income fund that we've been running with our partner since 2021, and that's been very well taken. It's produced 8% return, and we are also actively looking into some medical real estate and some retail development. If you're interested, definitely try to scan this QR code, and one of our team members will get in touch with you. With that being said, this is a QR code, by the way, just for the income fund. It's a minimum investment of 25K. It produces up to 8% return. The beauty of this income fund is that you don't have a lock time. In 90-day notice, you can basically pull your money back. If you are looking to get the slide, again, this is our number, 281-559-7061. You can call us, text us. You can even call us any questions. And if you want a copy of the slide, you can text us on this number as well. If you are unable to attend today, there will be a recording. So you will get the recording. So, if you don't want a physical copy, you can always watch the recording. This is our email, investor@headwaycapital.us. Our website is headwayinvestment.com. Definitely go check out our website. We have a monthly webinar schedule on those. With that being said, Farah, do you have any questions in the Q&A section?
Yes, Sid. Thank you. I think this was very detailed. I hope the session today, we had good takeaways from that. Now, I do have some questions in the chat, I believe, and some of our people who couldn't join also dropped some. So let's see which ones we can cover. So I'll start with the chat. Wen has asked, is immigration a big factor for the occupancy issues? Also, we hear more non-qualified applicants requiring a lot more cautious approach to review applicants. Yeah, this is actually true. We have been seeing a lot of fraud in overall. There's a report that I don't know if you guys. So there's a software we use. Most of our operators they use the same software called SafeRent or CoreLogic. They are integrated part with One Side, which is one of the very big software company for apartment complexes, and they came out with a report stating that the screening frauds have increased by 33%. That's
That's a very big number. So we have increased and improved our screening process. Not only that we screen residents for their income, their landlord feedback, but we also look at any pending litigation by going to the local court website. So that's an additional step that we are doing. We have been using an extra software to verify their pay stubs and things of nature. We've stopped doing that because those things are just getting hard and hard. Now our managers are trained more on just doing more due diligence on the screening, right? So really going through employment checks, really going through the local applicable laws for fair housing, as well as for landlord checks, past rental checks.
Amazing. And moving on to offlines, one question is, how do you think apartment investing in Houston will behave in 2026?
I think that's probably what we mostly covered. I think those pricing will go up. I don't think we will. There will be some distress assets opportunities around there as well. There will be some of the apartment complexes that were paid too much is not going to perform. So I think we that will also going to um, impact some of the opportunities. Overall, generally speaking, I think operators who are doing a good job with operations and keeping the running the tight ship, I think they would be able to sell the property for a much higher price. But I want to clarify one thing is that people who have paid way too much in 2022, 2021, and that makes some, in some cases, we also did that. Those assets you got to hold. You got to hold for long term to make sure either you refi it and you sell it when the time is right. So, there's always two school of thoughts. Some people think that, hey, look, you just sell it and take your money back and try to invest somewhere else, or you just simply hold long term to make your profit. So I'm indifferent. I look at market on its current instance and decide from there. So you overall Houston market, and it's going to be a hot investment year for Houston apartment complexes. Um, and unfortunately, I think the pricing will go up because the outside capital will pour into Houston market.
Amazing.
Thanks for
Heading back to the chat, Shahid has asked, the immigration crackdown is hampering occupancy. What is your plan to mitigate this issue?
we there's no one answer, to be honest. What we try to do is try to keep a very open communication with local law enforcement, and and that has been helping us, right? So what I've seen, people who are not engaging the local police, the cops, and the sheriff, they're the one who are getting more raids than ever before. Last year we had a pretty bad quarter, Q3 and Q2, and some of our properties got hit really hard. But luckily, we recovered from there, and now we're doing double checks and triple checks to make sure that we're not bringing problem when we're leasing apartments to those residents. So there are really three steps what we're doing. We're keeping our property super clean when we're screening people, and number two, we are keeping in a close contact with local enforcements, law enforcement. In some of our properties, we keep a relationship with the local police office so strong that we actually have a small sitting space in our property for those for patrolling police cops to come sit in our office and have a. Remember, when police is travel when they're patrolling, they need a spot where they can sit down, have a coffee, and some refreshment, and we provide that, right? So that's something that I think it's helping us. Now, honestly, if you ask me what exactly I'm doing to avoid that, that's nothing you can do really, except that in the engaging in local enforcement and screening the incoming clientele.
Great. Tanveer has asked, among the three investment classes, single family, medical offices, apartments, which one do you think is the best area to invest?
It's a tricky question. I think single family investments have been diluted so much that there's hardly any cash flow. You still have a good chance in apartments and medical buildings. If you're buying for single family houses just for appreciation and you're okay with um, uh, renting it out and even paying a little bit more out of pocket to cover the mortgage and things of nature, that's probably you want to be aware of that. For that reason, I think apartments, medical, and then single family. Probably that's how I would rank it.
In that order. Ven has asked, if outside capital comes in and prices are going up, do you plan to sell some assets?
We do, Van. I definitely do. I actually have a plan to. I don't know if I can speak it here openly, but I do have a plan to look very aggressively on one of the assets that you're involved in, and I've got three other properties in the pipeline that we're gonna try our best to sell this year.
Ken has asked, where do you see a big opportunity, Class A, B, or C properties?
It really depends, Ken, on which market are you in. If you are in Houston, I feel like you're somewhat better off with B and B products, maybe A. But you want to be very careful on the sub market and see where the supplies are. So you want to make sure that uh, this is something that you're checking if you're investing. You might have a really amazing investment opportunity in one of the areas, and next thing you know, that the whole area has been flooded with extra supply. That's a market you want to stay away.
And then said, how often do you bring investment opportunities in?
We try to do 1 to 2 a year in tough markets like this. We do have a plan to sell quite a few this year. There was a question from Brian about the spawns of Edge and 480. Yes, so Brian is, and we can talk separately, but Esperanza and Edge is also definitely on the docket for a possible potential sale. We are actually we're doing more renovation on 480, and you will get those updates as well. Those of you who are not aware, we're talking about some specific projects that we recently filed, and we're super proud of taking those properties out of the floating debt into the fixed loan. And our hope is that we're going to sell Esperanza and Edge, or at least try to sell it to see what kind of pricing we can get this year. But I don't want to dabble too much into it. I think that's a separate individual topic for updates. So Brian, definitely feel free to email us, and we'll update you more.
So, how do you guys do cost segregation in Headway?
Oh, I think there's somebody asked this question from the past webinar. We do cost segregation study for all of our projects, and that helps people who can that helps some people to get a tax benefit if if that's your situation. In short, whenever we buy a project, we do a cost segregation in the first month, really.
And then, how do you expect the US economy to behave
I think that's a
2026?
repeat question. Yeah. So I think we've gone through that. I think this is a submission from somebody who was not able to attend. I really think this is going to be an uncertain market. Think of it as choppy waters coming ahead, right? You're sailing on a ship. It was choppy last year. It will be choppy this year. It will be uncertain. But at the same time, this also creates opportunity for um, uh, recession resistant or resilient asset classes or boring businesses. I mean, for example, your apartment complexes, operations, leasing activity, this is still going to continue. Yeah, it won't be um, skyrocketing in performance, but it won't be the first one that get hits if we get to an uncertain time in 2026. And by
Okay.
the way,
And
I'm trying really hard to use and avoid the word recession, but that doesn't mean that it's off the table. I do think this is not where we are heading to. I really don't think this is going to happen in 2026. I do think there'll be some uncertainty in terms of job growth and inflation control. But as far as apartment complexes are concerned, overall nationwide, except few markets, I think your rent growth will be there, your occupancy will be higher, especially in areas like Houston or some of the areas that were even some more areas in Ohio and other areas, even some in Chicago as well. It was a very weird time of our life where we're seeing growth in Chicago just because there was no construction for a very long time. But when it compares to job growth, you still see Sunbelt as your top pick for the job growth and inward migration.
okay. And Sid, can you also touch upon income fund? There was an offline question, and Wen just left the question about it as well.
Yeah. So when this is an income fund that pays out 8%, meaning 25 is the minimum, and if between 25 to 99,999, it pays out 6%. But after you touch 100,000, it pays out 8%, and if you go over and above, it can go up to 9% or even 10%. Um, this is a straight up income fund that we pay out loan to. More like other smaller assets. The beauty of it, or what I like about it, that's a first lien position, right? So we have hardly any. I think in last 5 years we have one default that we were able to sell, meaning that if somebody is not able to perform on our loan, we take the property, right? And so that gives us a really strong control on what we can, how we hedge our risk on that. Awesome, guys. I think we are just 3 minutes off. Yes, when it is a hard money lending. Yes, and I don't want to use that word because it's a very foreign word for a lot of people. But yeah, it's a form of hard money lending. Excuse me. With that being said, I really appreciate everybody joining at 12, the lunch hour. And feel free to reach out to us. If you have any questions, you can email at investor@headwaycapital.us. You can go to our website, headwayinvestment.com. And if you are looking to call us, This is number 281-559-7061. Once again, thanks for your time, and hopefully we'll see you in February.
Thank you.
Thank you, Camilla. Thank
Take
you, Farah.